Okay guys, let's take a minute here to discuss the transactions that a company would need to record, or the journal entries that a company would need to record when they are involved in purchase transactions. So let's assume here on the 20th that this company here, Hartford Jewelers, purchased inventory of $5,400 on account, and the terms were $315 net 45. Now remember, from your reading of the text, that means you get a 3% discount if you pay within 15 days. And regardless of if you take advantage of the discount or not, you have 45 days to pay it. And the shipping terms are FOB shipping point. So that means that it's the buyer's responsibility to pay for the cost of the shipping. Okay? And it tells us here below here that the cost of shipping is $300. So we purchased $5,400 of inventory. We're going to pay for it later. And we need to add on to that cost of inventory the amount of cash that we're having to pay for the shipping. Now, the cost of this inventory to us just isn't the cost of the sales tag, but also it incorporates any amounts that it takes for us to get those items to us. Okay, so in this case we're having to pay $300. So if we sold this inventory for $5,400 and we paid $5,400 for it, we would actually be losing money because of that $300 that we also had to pay for delivery. So what we do, instead of treating this as an expense, we treat it as part of the inventory. And remember that inventory is an asset as long as we have it, and once we sell it, it then becomes cost of goods sold. So these are the two entries that are necessary to purchase it and to pay for the freight. We're going to see here on the 4th that we're going to make a return. And so that return is going to reduce, if we return $900 of inventory, that's going to reduce the amount that we owe them. So we need to reduce our accounts payable. But we no longer have that inventory either. So we need to show that we have a reduction in inventory, and we do that with a credit. On the 14th, it says that we paid Surrey Diamonds, and so we paid them on the 14th, and we have to remember that there was a return there that took place. And so this is what the entry is going to look like: $4,500 debit to reduce accounts payable, and $4,500 is cash that we're going to have to pay for that. Now you can see here we did not pay within that discount period, so we did not get a discount. The next thing that happened here is it says that we purchased inventory of $3,800 on account from Swift Diamonds. The terms are $310, so that means we get a 3% discount if we pay within 10 days. And the net amount, which means that if we don't take the discount, we owe them the full amount by the end of the month. That's what EOM stands for, and it's FOB destination. With FOB destination, we are not going to be required to pay for the shipping, okay? Because that means that it is the possession of the sellers until it arrives at our destination, and it's not typical for the buyer to pay for the shipping. So this is on the 16th, this is what this is going to look like. We purchased this $3,800 amount of inventory, and it says they're going to give us what's called an allowance. So sometimes if they send us something and it's damaged, or maybe it's a little bit off color or something, and maybe it's a pink instead of like a red, they might, if we call them up and discuss it with them, they might give us what's called an allowance, which means basically they are cutting off, reducing what we owe them. So if they cut off $800, and that means we really only owe them $3,000. But we're going to pay them within the discount period. So the discount period they gave us here was going to be for those 10 days. And you can see here that we got those guys. We purchased them on the 16th, and we're paying for them on the 24th. So we're not going to have to actually pay them the full $3,000, but we have to make that full amount of the accounts payable go away because we're settling up with them all the way right now. And so this is what the entry looks like. Cash is going to go down. Well, you know what? Actually, it makes more sense to first know that the accounts payable has to go all the way away. And secondly, come down here and calculate this discount. In this case, it was a 3% discount on the $3,000 of inventory that we're keeping. So 3,000 times this 3% gives us 90. So that means we got a $90 discount by taking advantage of the paying within those 10 days. So we owed them $3,000, but by paying them early, we only had to pay them $2,910. And so we're going to reduce inventory by this other $90 because the inventory cost should reflect what we actually paid for it. We only had to pay $2,910. If we drew a T account for this inventory, we'd see it started out at $3,800. Well, really started out at 0. Then we added this $3,800. Then we reduced it by $800, which left us there with that $3,000. And by now going in here and crediting it by 90, that leaves us with a balance of $2,910, which is what we actually paid for it. So I know this last little credit here seems weird, but if you draw a T account out, it should make sense. Okay, so now let's take a look at transactions that a merchandiser would be involved in, or the way we would journalize the transactions that a merchandiser would be involved in when they're making sales. So remember, merchandisers buy things and they sell them. So earlier we saw how to journalize the purchases. Now we're going to see how to journalize the sales. Oh, and I forgot to mention one last thing. If there is a case where it's FOB shipping point, this is with respect to a situation like up top where it's FOB shipping point with the purchasing. If that's the case, then the discount does not apply to the shipping; it just applies to the price of the goods. Okay, so back down here to the sales transaction. Let's take a look here. Austin Mall, it says, sold $10,000 of antiques on account. The credit terms are 1/15 net 30. 1% discount if you pay within 15 days. If not, they must be paid in 30 days. Cost of goods sold is $5,000. And so here this is going to require 2 entries now because we're using a perpetual system in this book. And so that means that we need to record the sale and also the reduction of the inventory. Should be familiar with this one here again. We have some sales, returns, and allowances. And so what this means is that now, instead of us being a second ago when we looked at it from the purchaser's perspective, if something showed up damaged, an allowance was allowed, and now we're the seller and maybe we sold something that showed up damaged. And so what we're going to do here is we're going to reduce the accounts receivable, we're going to reduce what they owe us in our records, and we're also going to instead of offsetting something like inventory or sales, we're going to use this contra revenue account, which means it reduces our revenue, called sales, returns, and allowances. That's what we're going to use. Okay, I know it seems a little weird, and it's a new account you haven't seen before. The same way we had contra asset accounts that were the opposite of assets, this is a contra revenue account, so it's the opposite of revenue. Now we also have to remember that the $150 of inventory is going to be impacted here as well. Okay, and so anyways, so this is what's going to happen there. They sent them back to us, so we reduced what they owed us, and we also reduced what we actually paid for them. Because remember, up here we record our sales and the cost of goods sold. Here we're kind of like doing just the opposite, aren't we? Except for instead of using the sales revenue account, we use this returns and allowances account. Now on the 13th it says we received payment from the customer on the amount due from January 4th minus the return and the discount. Okay, so first off, remember that we started out with the $10,000 accounts receivable, which was then reduced by $300, right? So that's what, $9,700? That's the amount of accounts receivable that's going to go away when they settle up with us, which is what they're doing right now. However, they paid us within that discount period, so they get a discount, $97. This is also a contra revenue account. We don't reduce revenue with a debit. Instead, we use this contra revenue account. And $9,603 is the amount here that they owed us minus that discount. And so these two together, this is a compound entry, and these two numbers together equal the $9,700. And so everything is good. That's the way this should be recorded. Let's take a look at some more of these. We're going to pay it says Austin Mall paid $120 on freight out. Now, oops, did I skip something? On the 20th, oh sorry, the first part. We sold $5,200 of antiques on account. Credit terms 110, net 45, FOB destination, and the cost of goods sold on those is $2,600. Remember, if we're the seller, we are the ones paying the shipping cost if the terms are FOB destination. Well, first off, we need to go ahead and record the sale, which we've done right here, and then the reduction of inventory and the cost of goods sold. Remember, perpetual systems, every time we make a sale, we have to make 2 entries. If this was a periodic system, we are not using that in this book, but if it was a periodic system, we would only make this top one, this top entry right here. But we're using perpetual, so it's going to take these 2 journal entries. And now, when we're selling something like this, when we pay, it's going to be treated differently than it would be if we were dealing with the situation when we are the buyer. When the buyer pays for shipping, we added it to the cost of inventory. With this, we just treat this as being an expense. So that's why we're going to debit delivery expense instead. When we purchased items that we were going to resell, whatever shipping we had to pay to get them to us, if we had to pay any, is treated as part of the inventory. But then when we turn around and sell it to somebody else, then we just treat that as being an expense. Might seem kind of weird to you, but that's just the way it is. On the 25th, it says we negotiated with a customer a $500 allowance on some cost of goods sold. So, not on cost of goods sold, which is an expense account, but on the goods sold on the 20th. So up here there was this sale. Now maybe something happened. It said there's an allowance. Maybe we sent them the wrong color. Maybe they were damaged. So we're going to knock $500 off the price. We're going to do that by reducing accounts receivable. And up here we're going to use this contra revenue account, sales, returns, and allowances. And then lastly it says we're going to receive payment minus that $500 allowance. So remember, the original amount was $5,200 was the amount of the sale minus the allowance, which means that in our accounts receivable we're showing that they owe us $4,700, and we're going to have to make that go away. And we're going to make that go away when we receive payment, and that payment is going to be $4,653. And we came up with that by saying, hey, what do they owe us minus that discount? $4,700 times 1%. So they got a $47 discount. So what this means is the cash that they sent us plus the discount that we gave them made the full amount of the accounts receivable go away. And once again, this is a contra revenue account as well. Please let me know if you have any questions, and have a great day.